Looks like the market decided to celebrate Black Friday. Dow slammed by 900 points in worst drop of 2021 on fears about a new variant. Dow down, S&P down, NASDAQ, Ruskies, European stocks closed down 3.7% amid concerns over new variant. Worst day since June 2020. Meanwhile, inverse ETF UVXY up almost 40% today at highs. Oil drops 12% in worst day of 2021, breaks below $70 as new variant sparks global demand concerns. Treasury yields tanked this morning as inflation concerns took a hike. Travel stocks decimated, beat down like geese in geese fire. Royal Caribbean down 13%, American Airlines down almost 9%. Ironically, ARK actually outperformed a lot of the market today. Actually green for parts of it because of Kathy's concentration of stay-at-home stocks like Zoom and Teladoc, which is kind of funny because last week we were talking about how the biggest threat to ARK imploding were her stay-at-home stocks because without a pandemic, they have to get on their actual natural growth trajectory, which can take some time. Now all of a sudden we got a new variant pumping them up. But the overall S&P, red as far as the eyes can see. Crypto market, you got Bitcoin down 8%, Ether down 10%, Binance down 8%, Solana, Cardano, XRP, Polkadot, and the Doge all hovering down around 10%. Somebody really needs to make a COVID coin because that would spread so fast. But why the panic selling? Well, many of the mutations identified in the Omicron variant are linked to increased antibody resistance, which may reduce the effectiveness of vaccines and affect how the virus behaves with regard to inoculation, treatments, and transmissibility. People, of course, panic sold a lot of assets today, and like with most negative catalysts, it's actually going to take a while to understand if there's really going to be a massive impact of this, or no impact at all. Right now, it's really just sheer speculation from people who are moving money around that have no idea what's going on with this virus. Who has said it will take weeks to understand how the variant may impact diagnostics, therapeutics, and vaccines? But of course, the market always has an agreed upon picture of what the future looks like, and when one thing changes, the future picture idealized version of what's going to happen 1 year, 2 year, or 3 year out becomes shattered, and for a moment, people start assuming the worst. I remember there was a specific day where the Delta variant really spooked the market, and the S&P sold off massively. It really started taking control over the headlines, and people decided, okay, I'd rather sell first and ask questions second. The S&P had a massive dip, and the media reported what? They said, hey, you need to make sure that you're avoiding the market. You don't want to buy the dip because we need to wait until this variant thing plays out. Of course, since then, the market has steadily gone up, and the same thing with all the other catalysts that were trying to derail the market. The truth is that both in the last year and over the long-term history of the stock market, the vast majority of negative catalysts don't pan out and are very overblown, and thus are historically always an opportunity to earn extra alpha by buying dips. But at the same time, I mean, we are in a stock market that's at all-time highs, and every new variant does bring with it a new set of potential risk factors and issues, and you can never really say for certain how big or extreme the impact's going to be. We went from the market anticipating a 2022 of us struggling mostly with inflation and interest rate increases to now the market anticipating a swarm of new cases, potential restrictions, and lockdowns internationally at the bare minimum. We're already starting to see that. If we start seeing an increase in case increases, you would bet that consumer spending and confidence would go down as well. And if that happens during this fall spending season, that would definitely not be a good catalyst. Whether you're a bull or a bear on this dip, there's a lot of different ways to play this, and you can make a good compromise that manages your risk and strategically takes advantage of these moves. So in this video, we're going to be talking violently about how to make money during this dip. There's 3 different ways that you're going to want to know about. And the only thing that I ask in return for all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Also, if you are looking to take advantage of our ZipTrader U Black Friday sale that we do once a year, well, I'll go ahead and put coupon code BlackFriday100 down below, as well as the link. Of course, this will be the last sale that we do before we raise the total cost of the program. So if you are looking to lock in lifetime access to our daily morning briefings, our private chat, our price targets, as well as our step-by-step lessons, well, now might be the time to do it. Make sure to check it out before the sale ends. Okay, so there's 3 different powerful ways to take advantage of this market condition. Let's start with our fear indexes. So, for folks who followed us in the beginning of the COVID crash last year, we got a lot of attention because we had called out fear index SVIX in the early days of the COVID crash, and it ended up going up hundreds of percentage points as COVID increased panic selling. Now, I didn't know to what extent the S&P was going to drop and fear was going to go up. We had never seen that sort of virus outbreak before, but we knew, hey, implied volatility is going up. Things are getting crazy. Fear's going up. People are panicking. It's time for SVIX. And that fear, of course, eventually subsided. But while it was here, it was a very powerful opportunity opportunity. And while we are unlikely to get another opportunity to that extent, even smaller fear cycles can be something that's very, very useful to both hedge against your current portfolio as well as make money off the moves instead of just kind of sitting there and watching the moves. There's always short-term fear cycles, and fear has been low for quite a while now. So how do you play it? Well, Schvix has been discontinued, but the new fear index that I include on the briefings and that we talk about somewhat regularly on the channel is UVXY, and obviously that was up something like 40% today. Of course, it's difficult to predict when you're going to get sudden massive spikes in fear and implied volatility. By the time that I realized that this new variant situation was a big deal for the market was around the time that futures were already tanking and European equities were tanking. And obviously with that situation, when the market's closed, you're not going to be able to buy UVXY and it's just going to gap up massively before the pre-market. But a lot of times it still has a lot of run left throughout the day. And if you can identify a broader trend, you can play the panic and fear catalysts while they're here and then avoid them when they're gone. A thing to be careful of though is that of course the market goes up over time and fear doesn't last forever. UVXY is a killer for trading off fear, but if you want to directly short the market, obviously you could use funds like SPXS, which shorts the S&P 500, or SQQQ, which shorts a more tech-centric fund. Of course, catalysts change, and most of the time, dips this year haven't lasted very long. So if you're going to play with these, you definitely want to play with them on a very short-term basis. The second way to play is with momentum stocks pumped up by the fear. Every single fear catalyst has a reason behind it. This time it's this variant. And what does that create? Well, it creates a lot of spec capital going into vaccine stocks, COVID care stocks, stay-at-home stocks, and so on and so forth. For example, vaccine and or treatment stocks like Moderna rose dramatically this morning on news of this new variant, but some of the smaller spec players that were already relevant prior to the catalyst are going to outperform on days where the market-wide trading is around some new piece of fear. For example, we briefed on our ISPC play earlier this week as they were chosen by the US government and private researchers to supply needed human specimens for the virus research. It went up during that time period on the catalyst before people took profits, but just the sheer fact that the market knew that they were working on this and had just got this contract led them to doubling again at highs this morning. So when you see a new fear catalyst, it's very, very helpful to keep track of stocks that are working on some solution to that fear, whether that be direct solutions such as a vaccine, a treatment, or an indirect solution such as something to occupy the economy while the virus thing gets worked out, stay-at-home stock, Zoom, Teladoc, and so forth. A lot of those opportunities will turn into momentum plays if this narrative goes on for longer. And for the next 2 weeks, you're going to see a lot of speculation over this before we get more data as to how dangerous this really is or if it's really just a non-starter. So tracking and having these violently on your watch list is something that's very, very important, especially if you're a short-term trader. But the third and probably the most lowest maintenance, highest returning way over the long run to play off this fear is to simply find stocks that are dipping way below their fair value. Most people have no problem buying stocks as they break out into new and higher highs, but they have every problem in the world of dip buying a stock because, ooh, what if it's a triple layer dip? But if you did the work on a stock that's say at $50 and it dips to $30 and you believe that the value of it is actually $50, then who cares if it dips to 25 or 20 after you buy it? Just buy more. You can never say for certain how much the market's going to take your stock. So if you're not buying the dips and if you're not taking advantage of dips that make sense, risk versus reward, I'm not talking about a 5 to 10% dip, I'm talking about a sizable dip, then the problem really isn't you not buying the dip, it's that you don't believe in your own analysis. So that means that you have to go back to the drawing board and make a list of stocks that you see good value at what prices, and then if they dip below those prices, hey, cha-chinga. If you're somebody who trades on conviction and fundamentals on your analysis of a stock, the market goes through periods where it doesn't give a shite about your predictions. Even if your company is going to do much better than what you thought, the market may not give it any money until it actually shows that proof of concept or you get the right market sentiment. So in a fear period, you need to be very, very confident in your valuation analysis and have a list of stocks that you want to dip by and then dip by them violently. You can't control how much people beat down your stocks based on market sentiment or their own emotions, but you can certainly control how many shares of undervalued stocks that you buy. Since the COVID drop, the market has been able to brush off every single dip in a very short time horizon, and you look at even the COVID drop, a lot of people were called idiots for buying halfway through the dip because, oh no, it's going to be a triple layer dip, and it did dip more. But if you bought high conviction stocks even halfway through, or even before it dropped, you still did very, very well overall. Obviously, going into 2022, the Fed may not be as aggressive at helping pump asset prices back up. But overall, if you're buying stocks that you would have been happy to buy at much higher highs just because they're going up, well, the time to buy them is actually when they're going down. The time to buy them is when everybody else thinks they're trashed because, oh no, short-term fear. And overall, if this variant becomes a starter heading into 2022, I'd argue that tech stocks and growth stocks specifically would be huge winners. The biggest threat to tech stocks and growth stocks are really interest rate spikes. If the variant becomes a bigger issue, the Fed is going to have a completely different outlook on how fast they want to raise interest rates. And at the same time, tech stocks tend to do very well in COVID-related environments. A lot of them aren't really impacted negatively by restrictions. They are some of the most resilient. But there's a lot that we can't control and can't predict. So I think the key, like usual, is focusing on finding stocks that you really, really believe in and buying them at prices that just seem ridiculous based on how much value they're going to provide. And we could very well see some of those opportunities in the upcoming weeks. Okay, and lastly, what's the worst thing that you could do during fear? Well, a lot of retail traders historically, what they'll do is they'll go and they'll buy relentlessly when the market's breaking out into all-time highs and the media's pumping out bullish articles. And then what happens? Eventually you get a negative fear catalyst, and retail traders do the opposite. They say, oh no, I better go and panic sell everything that I just bought at all-time highs, and I'll re-enter when this fear is out of the market. But of course, by the time the fear is out of the market, it's already at a new all-time high. So in effect, market cycles almost always just churn retail traders, getting them to buy in at all-time highs and getting them to sell out at all-time lows. When in effect, if you just went in with a clear plan, a clear entry-exit plan, a clear risk management plan, and an overall written reason that you're in the position, you would be a lot more immune to these cycles. Anyways, that caps off the video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to join us before our Black Friday sale expires, make sure to type in coupon code BlackFriday100 when checking out with ZipTrader U, and you will get $100 off. This will give you lifetime access to our step-by-step lessons, our private chat, our daily morning briefings, as well as, of course, our price targets. So if you do want to join us, make sure to check us out below. Anyways, that caps off the video. Have a good one, and I'll see you in the next video.